Welcome back to Real Estate Economics weekly webinar series for Fresno, California. At this point, we've provided a little bit of background information on what's taken place in this market over the last 5 years. We'd like to look at some of the leading indicators and a little bit of their history and look out for a 5-year forecast on some of these things. This particular graph is mortgage interest rates covering 30-year fixed-rate loans, national averages. Please recognize these are yearly numbers, so the on-the-ground price today might be a little bit different. I think if there's anything to take away from this, it's look at the direction of rates since 1990. They've been steadily lower. Lenders have become much more efficient in generating mortgages. Despite the subprime debacle, there was still a streamlining in loan origination processes that took place during that time that made a mortgage much cheaper to originate and put quite a few efficiencies into the system. Now we'll probably have to have the pendulum swing back a little bit the other way, but it's become less expensive to create and get a mortgage over this time period. We show a little bit of price increase in our forecast from 5% currently to 6.3% in the out years. That may develop very slowly. If you watch the Mortgage Bankers Association numbers, current 30-year rates hit an all-time low this week, and we just really have yet to see the market reverse and show us any higher rates. If you look at the numbers in 2008, the average rate was about 6%, and we went to 5% in 2009. That was government intervention, but a 1% decrease in rates like that allows the average household income to buy much more home. We'll see that in some later slides. That's a tremendous support to the market, but as rates trend back higher, if and when they trend back higher, that's going to put a little bit of lid on price appreciation and keep the market from really running away from us price-wise. This is a chart of 10-year Treasury bonds going back to 1969. And I'd like to make the same point as the last slide. Throughout this period from about 1982 through today, interest rates have been in a very long super cycle downtrend. If we're going to have some sort of significant reversal in mortgage interest rates, it's going to have to fight off some deeply embedded cycles and may take some time to develop. Now, I think a lot of people would have the point of view that the government spends too much money and there's a day of reckoning. That may be so, but if it is so, it's going to take time to develop on the ground, and it's going to have to work its way through a very deeply entrenched long-term cycle. A lot of this relates to increased efficiency in the capital markets, electronic transfer of funds, and a whole bunch of wide-ranging processes that have made credit more readily available until recently, but also much cheaper over time. I put this in because you can see the Japanese economy is on a little bit farther ahead timeline, if you will, than we are. They have much of the same demographics. They have a baby boom generation that's a little bit older than ours. They're having fewer workers enter the workforce than we have, and so some of their experiences may give us some ideas about what will transpire here. But the point I'd like you to take away from this slide is interest rates in Japan have been coming down for years and are under 2% for since about 1996. In the past couple of weeks, the Japanese 10-year government bond got down to 1.15%, lowest number in history. So there are a lot of international trends that suggest rates are very low. If we have some blowback over high government deficits and that sort of thing, again, it's a phenomenon that may take years to develop, may develop very slowly, may develop in fits and starts, and no matter how pronounced and profound it becomes over time, it's something that may not be right around the corner. Some of the other leading indicators that correlate very closely to housing, this is lumber. This is a lumber contract on the futures market traded at the Chicago Mercantile Exchange, specifically for 2x4s, which we'd consider to be framing lumber. The contract size is 110,000 board feet, so it's really a wholesaler, large builder, large producer market. Home Depot might be big enough to play in it, but it's generally something that requires some size. You have to post margin and there's contract requirements, that sort of thing. I use this particular time frame because you can see at the left the market was fairly decent in the middle of 2008 and then came way down under 160. That is the price per 1,000 board feet of lumber, $160. So in early 2009, the market had come all the way down under 160 and really had given up about $100 per square foot, as participants in this market did not see a quick rebound to the housing market and thought that lumber prices might be depressed for some time. Over the course of 2009, though, this started to rebound pretty smartly, and by 2010 we'd started to get very optimistic. This market ran up from about 220 to over 320, really in the anticipation that we are going to have some sort of V-shaped economic recovery and the housing market would return very quickly. We've seen, though, just in the last month or two, maybe 6 or 8 weeks, the market has reversed and gone from 320 all the way back down to $180 per 1,000 board feet. At a minimum, that is telling us that the participants in this particular market think the second half of 2010 is likely to be weak, and we would watch this closely into the spring of 2011 for signs of improvement. But there's probably not too many indications that many people are interested in holding lumber through the back half of 2010. We also look at the supply chain. This is Louisiana Pacific Company, traded every day at the New York Stock Exchange. Louisiana Pacific is a maker of engineered wood products, oriented strand board, subfloor systems, that sort of thing. This particular chart goes back to 2008. You can see the same phenomenon as the wood chart. On the left-hand side, the market is moving along in a normal sort of pattern, and then all of a sudden we have the economic meltdown, and the stock for this particular industry group just fell apart. And this is just one example of many, reaching very, very low levels through early 2009. And then we got the anticipation of a recovery, which accelerated into about April of 2010 here, when the market became probably way over optimistic about the strength of the recovery. Corporate earnings were good, and a lot of people were jumping on board saying we'd turn things around. If anything, we've learned that the economy is does not equal the stock market, and some of that euphoria has come out of the market, and some of these wholesalers and supply side companies have come down quite a bit in the past few weeks. How does that apply to the housing market in Fresno? This is a survey-to-survey comparison of active communities in this market that Real Estate Economics surveys every quarter. In the first yellowed bar, I'd like you to look at the number of active developments. You can see this has come down quite a bit from 69 in 2008 to 49 presently. You think, well, maybe that's not that big of decline. Let's dig into that number just a little bit more. Out of those 49 homes that we're showing as active, 9 are on hold. We would continue to keep track of them until all the units that are zoned in that subdivision are closed. So we know that the competitive levels are actually lower, and then another 16 out of the remaining 40 have released all their units. So really we have only about 24 active communities in this market at this time. In the second yellowed area, you can see that home sizes are coming down. That's natural response to price pressure, and we think that's heading in the right direction. Go down a little farther, you can see total unsold released inventory has come down from over 1,000 units to just 219, and months of unsold released inventory down to just 2.4 months. So we're getting a drawdown in inventory in this particular market. We're getting a drawdown in competitive levels, and we're starting to see some holes in a number of high demand price points and unit sizes that will gradually help create market opportunity going forwards. That's the end of part 3. If you're interested in seeing all 4 parts, there's one more.